If you own a home and you're 62 or older, what I'm about to share with you in the next few minutes could save you thousands of dollars, or cost you thousands if you ignore it. Because starting June 1st, a new wave of regulatory changes is hitting senior homeowners across the United States, and most people have absolutely no idea it's coming. I'm talking about restrictions on how you can use your home, how your property is assessed, and in some cases, whether you can even rent out a room without triggering financial penalties. I've been working in retirement and real estate finance for over 2 decades, and I can tell you honestly, this is one of the most significant shifts I've seen for senior homeowners in a long time. So today I'm going to break this down into 5 levels. Level 1 is just basic awareness, what the ban actually is. By level 5, we're talking about the advanced moves that smart homeowners are already making right now before June 1st hits. Let's get into it. Level 1, what this ban actually is and why most seniors have no idea. Most seniors are stuck at level 1, and honestly, that's not their fault. The media isn't covering this the way they should be. Here's what's happening. Across multiple states and federally at the HUD and FHA level, there are new compliance rules going into effect on June 1st that restrict how senior homeowners can leverage their primary residence for income and benefit purposes simultaneously. What that means in plain English is this. If you are receiving certain federally assisted retirement benefits, or if your home is financed through an FHA-backed loan, including a reverse mortgage, there are now hard limits on what you can do with that property. You cannot rent more than one room without reclassifying your home. You cannot list it on short-term rental platforms like Airbnb or VRBO without triggering a review of your benefit eligibility. And in some counties, simply filing for an additional homestead exemption while having a rental agreement in place will now flag your property for reassessment. I know that sounds like a lot, but here's the thing. Most seniors find out about rules like this not from their financial advisor, not from their lender, but from a penalty notice in the mail. That's level 1. You now know it exists. Let's go deeper. Level 2, how the ban affects your property taxes and homestead exemptions. Here's where it starts getting expensive for people who aren't paying attention. In most states, if you're 65 or older, you qualify for a senior homestead exemption, sometimes called a senior freeze, that limits how much your property taxes can increase year over year. In Florida, Texas, Arizona, and about 30 other states, this exemption is a massive financial lifeline. We're talking about saving anywhere from $800 to $4,000 a year on your tax bill. But here's the catch that's changing on June 1st. Under the new compliance framework, if your home is generating any rental income, even from a single room, even from a family member paying you rent, and you have not properly disclosed that to your county assessor's office, you are now at risk of losing your homestead exemption entirely. Not just for this year, retroactively. I've already spoken with homeowners in Georgia and Ohio who received back tax notices going back 3 years because an auditor flagged their property after cross-referencing rental platform data with county tax records. 3 years of back taxes plus penalties. One couple owed over $19,000. They had no idea renting the basement to their adult son for $700 a month would cost them their exemption. This is why Level 2 matters. You need to audit your own situation before June 1st. If you are receiving any rental income from your primary residence and you have a senior homestead exemption in place, call your county assessor this week and ask how the new compliance rules affect your specific filing. Don't wait. Don't assume you're fine. Level 3, reverse mortgages, HUD rules, and the income trap. Now we're getting into territory that affects a significant number of seniors, and this is where I see the most confusion. If you have a reverse mortgage, or if you're considering one, you need to understand how these new rules interact with your loan terms. A reverse mortgage through the FHA's HECM program requires that your home remain your primary residence. That's always been the rule. But what's changing on June 1st is the enforcement mechanism and the definition of what triggers a compliance review. Previously, a borrower could informally rent a room, and it would rarely come up unless they were audited. Starting June 1st, mortgage servicers are now required to flag accounts where rental income appears on tax returns or banking records and cross-reference that against the primary residence certification you sign every year. If there's a discrepancy, they can issue a due and payable notice. That means the full loan balance becomes due immediately. For a senior living on Social Security with a $200,000 reverse mortgage balance, a due and payable notice is catastrophic. It can trigger foreclosure. Now, here's what makes this an income trap. Some seniors have been renting a room precisely because they need the extra income to afford to stay in their home. They're renting a room to pay the utility bills, to pay for prescriptions, and now the very strategy they're using to survive is putting their reverse mortgage at risk. The answer is not to stop renting. The answer is to restructure how you do it and get it properly documented. There are compliant ways to have a border arrangement under HUD guidelines, but you must have it in writing, and it must meet the specific criteria that HUD outlines for HECM borrowers. If you have a reverse mortgage, call your servicer before June 1st and ask them specifically about the new border income guidelines. Get the answer in writing. Level 4, insurance implications and what your homeowner's policy won't cover. After June 1st, this is the level where smart homeowners are already taking action, and it's the one that catches people most off guard. Your standard homeowner's insurance policy is written to cover a primary residence. The moment your home takes on characteristics of a rental property, even partially, your coverage can be voided. Insurance companies have always had this clause buried in the fine print. But starting June 1st, several major insurers, including 2 of the top 5 carriers in the country, are updating their claim review process to specifically flag properties where rental activity is detected through public records or third-party data. What that means practically is this: you have a kitchen fire, you file a claim. The insurance company pulls your property's data profile and sees that your address appeared on a rental listing or that you reported rental income on your Schedule E. They now have grounds to investigate whether your policy accurately reflected the use of your property. If it didn't, they can deny the claim. On a kitchen fire, we're talking about a claim that could easily be $50,000 or more in repairs. Denied, because you were renting a room and didn't update your policy. What smart homeowners are doing right now is calling their insurance agent and asking 2 specific questions. First, does my current policy cover occasional rental activity or border arrangements? Second, do I need a rider or an endorsement to make sure I'm fully covered? A rental endorsement typically costs between $150 and $400 a year. That is nothing compared to a denied claim. Get this handled before June 1st. It is a phone call that takes 20 minutes and could protect you from a financial disaster. Level 5, the advanced strategy. Restructure before June 1st to protect everything. This is where the conversation shifts from defense to offense, and this is what the seniors who are truly financially prepared are doing right now. Level 5 is about proactively restructuring your situation so that you stay compliant, you keep your benefits, and you actually maximize your income and tax position going forward. Here's what that looks like in practice. First, if you want to generate rental income from your home and you have a reverse mortgage or a homestead exemption, consider establishing a formal border agreement that complies with HUD's primary residence rules. This means a written lease, fair market rent documentation, and a clear paper trail. Done correctly, this income does not jeopardize your HECM and may actually be excluded from certain income calculations for benefit eligibility purposes. Second, talk to a CPA who specializes in senior real estate before June 1st about how rental income from your primary residence is reported differently than investment property income. There are deductions and offsets available that most people never claim because they don't know to ask. Third, if you own your home free and clear or have significant equity and you've been considering a reverse mortgage as a financial tool, get your application in now before the June 1st rule changes potentially tighten the eligibility review process further. Lenders are already seeing a surge in applications from seniors who understand what's coming. Fourth, if short-term rentals have been part of your income strategy, it may be time to evaluate whether a formal accessory dwelling unit, a legal in-law suite or garage apartment, might be a better long-term structure than renting rooms in your primary residence. In many states, an ADU is assessed and insured separately, which protects your primary residence exemptions and insurance coverage. And fifth, and this is critical, review your estate plan. Because these new rules don't just affect you today. They affect how your home transfers to your heirs and what liabilities might come with it. If you haven't sat down with an estate planning attorney in the last 2 years, this is the moment to do it. Look, I know that was a lot of information, and I want you to take a breath for a second, because the goal here is not to panic you. The goal is to make sure you are not blindsided by something that is entirely manageable if you act before June 1st. Let me give you the 4 things you need to do this week. Call your county assessor and ask how the new compliance rules affect your homestead exemption if you have any rental activity. Call your insurance agent and confirm your policy covers your current use of the home. If you have a reverse mortgage, call your servicer and ask specifically about the new border income guidelines. And if you have any rental income at all, sit down with a CPA or financial advisor before June 1st to review your reporting structure. The seniors who are going to be hurt by these changes are the ones who do nothing, the ones who assume someone would have told them, the ones who find out in August when the notice arrives. Don't be that person. You watch this video, you're already ahead. Now I want to hear from you. Drop a comment below and tell me, are you currently renting a room or any part of your home? And did you know about any of these changes before watching this video? I read every comment and I respond to as many as I can. If this video helped you, or if you know a senior homeowner who needs to hear this, please share it with them right now. This is exactly the kind of information that gets buried and never reaches the people who need it most. And if you haven't subscribed yet, hit that button and turn on notifications because we cover retirement and real estate finance every single week. The real stuff, not the fluff. I'll see you on the next one.